Y ahora quiero dar la bienvenida a Lev Masur, quien nos acompaña nuevamente. Estuvo en abril en el evento que tuvimos de Talentland at Home y ahora nuevamente nos acompaña para una plática que va a tener. Y para presentarlo, bueno, él es Lev Masur, CEO de Quant Fury. Va a la plática Operando Activos Financieros. ¿Cuáles son las implicaciones prácticas y fundamentales? Lev Masur es el CEO de Quant Fury, conocido por brindar condiciones operativas y de inversiones sin igual a los traders minoristas de todo el mundo. El señor Masur es un emprendedor experto en tecnología financiera y un experimentado trader de futuros y divisas. Después de una exitosa carrera de 24 años en el trading y la tecnología, el señor Masur, junto con un grupo de ejecutivos de la industria financiera, ha fundado Quant Fury, la plataforma de comercio de más rápido crecimiento en el mundo, un nuevo paradigma de corretaje que garantiza a sus usuarios la ejecución de operación y o inversiones al tamaño solicitado a precios directos desde los intercambios globales y criptos intercambiados, libres de tarifas de creador o tomador, tarifas de apalancamiento y cualquier otra tarifa, utilizando criptomonedas. Y ahora vamos a pasar con Lev Masur. Lev, thank you for being once again with us in Blockchain Land at Home and welcome.
Thank you. How are you doing?
I'm doing great, thank you. So last time we had a very casual talk about everything you saw about the entrepreneurship and about it. What are you going to talk about this time?
Well, I mean, you made us. I partially understood what you said. You spoke quite a lot about Quant Fury. I don't want to really talk about Quant Fury at all. If we could really take that name out of the equation, and I appreciate this opportunity. I really wanted to share with your listeners, with people who are living in Latino world, Spanish-speaking world, Central America, Latin America, South America, obviously Spain as well, who those days focused on a blockchain, focused on trading. I wanted really to share with them some of the experience and some of the knowledge I have, so to speak, give a maybe different angle of how I perceive this field. And I think it could help them maybe not to indulge themselves in a very dangerous business of trading, speculating various financial assets. And I wanted really to talk about the fundamentals behind it, traditional assets and as well as blockchain digital assets. When I started my work, it was about 28 years ago in 1992. And at that time, to trade anything, you really had to work in a financial institution. And I started working in a bank. And, it was two really financial assets that were dominating back then. It was Forex. It wasn't euro back then, and it was also stocks. And obviously, there were some other products, options and fixed income products. And in order to trade those products, you had to work in a financial institution. And it required a certain level of understanding those markets and understanding how they work. Today, the situation is slightly different. Everybody has, access to the internet. Everybody has ability to log into various information systems, and everybody has ability to kind of send money digitally, be it a crypto or be it a fiat, and then access to various information flowing on those in those systems, and trade that information, be it stocks, quotes, or be it Bitcoin prices, Bitcoin against other currencies. And pretty much everybody, you don't have to work in a bank or any financial institution or understand certain underlying values behind it. You can just go in and start gambling, betting, losing money. I always mention that those statistics that 90% of the people trading, 80 to 90% of the people trading lose money. And they lose money not to platforms that operate it, but they lose money to other 10% of the market, obviously. And that's just the simple people, retail traders. But nobody knows the statistics that the hedge funds, the 90% of the hedge funds that are professional financial institutions, when they start trading in the first 3 years, they close their doors, they shut down because they're not profitable, because they lose money too. So it's not just certain people that don't know what they're doing. A majority of the market losing money, and that happens um, because of the simple mathematics. And when the people start trading, they have various theories how they're going to make money. Some of them have a sense, a feeling, this is going to go up, this is going to go down. Some of them have some strategies, news related strategies, technical analysis, charts, swing, economic news, which is a macroeconomic analysis of economy that in today's economy sometimes doesn't work, because we have a lot of governments that unfortunately perform non-fundamental sound from the science of economical science perspective, um, policy, monetary policy. They pump money into the systems and make stocks go up against any logic and so on. However, having said that, whatever your strategy is, there's a certain rules that underlie the results of whatever you're going to be doing trading financial markets or digital assets. And the first rule is that if you trade randomly, and meaning randomly that you don't have a strategy, you don't have a book and the rules when you buy and when you sell, and you don't need to back test those rules necessary, which would be very good if you can do it, but not everybody can do that, have access to the historical prices, and can run programs and back test that strategy for years backward. But let's say if you have a strategy that tells you exactly the rules how you're going to trade, otherwise you trade randomly. And this is a big secret that nobody wants to tell you. And nobody, when we talk about nobodies, is the nobodies means the big players, those who know what they're doing. Because if you trade randomly, that means that the results will be random. That means you would be losing and winning the same amount of times. Like a random number theory, which is a mathematical theory that says that if you are going to randomly drop a 0 or 1 number 1 million times, 50% will be 0, 50% will be 1. But unfortunately, in the stock market or any market where you trade, it's slightly different, because there's an edge against you. When you buy, you always automatically lose against the sell price, because you buy always above the sell price. And if you sell, you always have that loss, because the price has to go higher to meet the sell price, so you can get out of the position. So that buy and sell price is just a market liquidity. It's not done against you. It's just there. So if you trade randomly, like most of the people do, that edge, the difference between the buy and sell price, that difference statistically will be the average loss that you will incur, at least trading. So if you traded 50 times a day, and the difference between buy and sell price was 0.01%, you will statistically lose that edge, that spread, 0.5%, times 50 times you traded. Yes, you could be winning 25 times and losing 25 times, but the zero net game, that spread will be against you. The same thing will be the same fees and commissions. They will be also adding statistically against that random number theory, which actually very similar to casino. Not many people understand how casino work. They claim that casino, fake the results, but they don't have to. They work with the same random numbers theory. When you walk into roulette table and you gamble, you get paid one of the 36 numbers, but there's a 37 numbers in the roulette table. So the casino has a 2.7% edge against the gambler, and the average lose 2.7% of their bets according to the random number theory. So all the people lose if they trade randomly. In average, that cost of their entry and exit, which can be fees, which can be spread between buy and sell price. A lot of platforms those days say, we don't have no fees, but they will manipulate and expand the buy and sell prices. And that fees will be incorporated there, so people will lose that way. So if you don't trade with strategy, with some rules that you see it and you make them, the chances that you will lose that cost of entry and exit, which is a fees and difference between buy and sell price, is mathematically soundproof. It's mathematically going to happen. And it's not just by mistake. And a lot of hedge funds managers don't know what they're doing, and a lot of retail traders don't know what they're doing. So unless you have that capability of knowledge and strategy and the rules of entry and exit, that's obviously a very important thing. Another thing which people need to understand is another theory, fundamental theory behind trading, which is called prospect theory. And a prospect theory says that people are attached to their losses much stronger to their wins. In other words, if you lose $100, you will be mad about it much more than making $100. And as a result of it, people are attached to those losses. They are not tolerating them. When you lose $100, you're basically saying, no, it's not going to happen. I'm going to win. I'm not going to close the losing position. And when you're winning something, you just take it very quickly because you're kind of want to get that quick, and it's something that you accept right away as a normal thing. So that prospect theory also tells that the people expectations a lot of times are not real. So when somebody trades, and if they don't have emotions part out of the trading, when they have their strategy with a very simple and straightforward rules that talk about the risk and the discipline against the greed or against their expectations, whatever they're going to be, most likely that they will be losing money even above those fees and commissions different between buy and sell price that set up mathematically their average loss of trading. I always mention that I stand against the greed and I'm in trading. A lot of people say, well, you must be a hypocrite. But all of those people obviously don't have a fundamental knowledge that a good trading today set by a Sharpe ratio. It's very simple. Sharpe ratio is SHARPE. Everybody can Google it. Every hedge fund, every mutual fund, every reputable financial institution in the world will work according to that Sharpe ratio, meaning measure their traders, their investors, their investments, strategies with Sharpe ratio. And the Sharpe ratio talks about, sets very simple principle. It's a principle of steady returns where the risk management is the key. In other words, 10 years ago, if you would be hired to the hedge fund, you would be asked a question: what kind of trader you want to be? If you get $100 at the beginning as your AUM, as your money that you manage, and then a year from now you're going to get $150, but at that time your $100 at one point went to $80. Or what's better? The question would be, or you get $100 and at the end of the year you get 115. But every day you get a steady growth, and you never had your managed capital of original $100 go below that $100. And the question obviously is second. So it's not really how much money you make, it's what that is the risk and the deviation of losses and gains that you have. More steady it is, meaning more steady you make money and more steady you lose money, and there's certain rules behind it, so there's certain borders between them, better trader you are. So word like a discipline, it's actually antonym to the greed in certain dictionaries. And when I say I'm against the greed, that's actually a very key definition to good habit in trading. And the fundamentals like prospect theory talks about that specifically. So it's not just you need to have a strategy, but you also need to have a certain rules of risk management that set your expectations a little bit smaller, where you do not tolerate big losses and you tolerate big wins. And that is important today for anybody who wants to trade. And today, in today's environment, trading is really looked by millions of people as a tool to make money. And unfortunately, there's many platforms out there that talk about trading as a vehicle to become, extremely rich, which is obviously not true. How many of those platforms show you as a trader, as a simple guy, what kind of strategy you have and what kind of Sharpe ratio you have there? How many influencers who talk how great they are and sell their signals and talk about how well they manage their portfolios, they show their Sharpe ratio? Not many, because that 10% out there who wins, it's very small percentage. So how you can actually win consistently? And that's a very good question. In theory, one cannot win more than what market makes. So in other words, if the stock market went this year 50%, you cannot really make more than 50%. And there's a last third theory behind it, talks market efficiency theory. The market efficiency theory says that every market participant has access to the same information, meaning that I know about the same technical analysis and about the same news and everything is published, and nobody has insider information. And therefore, if somebody has insider information, he's supposed to go to jail. That's illegal. So when you look at the regulated market and traditional financial markets, the markets are efficient. We hear sometimes about some insider trading case where some guys getting advantage and getting some information or paying some bribe to get information about pending quarter earning release of certain company. And that's not fair. That's against the market efficiency. Market has to be efficient. Some get that leverage and become have efficiency, making for themselves a market advantage by computing skills. So let's say they get, everybody maybe heard about high frequency trading. This is a computing capabilities that allow certain companies to calculate miscalculation of various assets that human brain cannot do it. Is it legal? It is legal because that information that they're calculating available to everybody. So you can also buy such computer for a couple of $1,000,000 and do the same. But obviously, it's not that much fair. But the traditional market is efficient. So when you start building your strategy, you must look at information you access to in a way that you want to get to much more deeper level of information that maybe not everybody is looking at, and try to build that strategy based on certain things that maybe is overlooked, so you get some advantage from the market efficiency perspective. But let's look at the digital assets. This is a very interesting area because that area is not regulated. So when you look at the exchange, what you trade, let's say Binance Exchange or BitMEX or other places, I'm not going to talk about Quanfury because it's not really about it. You have prices and you traded those prices, but the question is if the market is efficient, and we know it's not, because the exchanges that you trade at actually trade themselves in those exchanges. And we know that for a fact. We know that the BitMEX has its own OTC desk. Imagine yourself that NASDAQ or New York Stock Exchange would have its own desk trading the same securities that Goldman Sachs or JP Morgan is trading. That would never happen. I mean, if it would happen, a lot of people would go to jail and pay big fines, but it just not be fair. But it's happening today. And that makes market extremely inefficient. And that makes traders with legitimate strategies and a great Sharpe ratio being exposed to those who have a not fair and probably illegal advantage. It's not from the law perspective, but from just a human and business ethics. And that must stop. And hopefully that will stop, and those exchanges will do them put on some self-regulatory measures. Like, for example, in Quantfury, I want to mention just once, we do have a smart contract that shows all the trades and all the prices, and we stamp print the prices. We show this the print screens of the prices that happen at that moment, on the particular specific exchanges that we bring prices from. But in general, a lot of exchanges can also self-regulate, but also can regulate themselves. It can make sure that the conditions they operate are market efficient, and everybody is equal in that space they're operating. So to summarize, if you trade, don't rush to press bid or ask price. Don't listen to the people who tell you what to do. Don't go and try to reach forward. Go backward. Check what is Random's number theory. Understand that cost of entry and exit of your trade is the most important and undeniable empiric value that you can measure. That must be the most efficient, because that was the most important for your success as a trader. And build a strategy with appropriate risk management, and know that the greed is something that you have to fight against to be successful in this business. And that's really, I wanted to give you kind of a very short overview, which I really don't see anything above that or behind that to talk about the trading. And this is what I do for many years. Obviously, everybody made mistakes, me included. But that's how I would look at trading today, traditional or digital assets, and the fundamentals behind it.
Thank you very much, Lev. And just remember that you can leave your comments and all your questions in the chat. Recuerden que pueden dejar todas sus dudas y comentarios para que Lev les conteste durante la conferencia.
And everybody can find me on Twitter at Lev Mazur, CEO Quantfury, and send me messages. I always like to give my view to the traders out there, and my job, I really look at that to limit the losses of people, and the winnings they can take themselves and enjoy them. That's pretty much how I look at it. So I'm more than happy to talk to anybody, and I can actually speak Spanish a little bit, so it can be done in Spanish, no problem.
Awesome. Great. Thank you very much for being with us in Blockchain Land at Home, Lev. And remember to look him up in Twitter and leave all your comments and questions so we can answer it on the chat. Thank you very much.
God bless you. Thank you.